second video where I'm giving you some instructions about how to use the SCORE financial projection model. This is the template that creates financial statements for us. So we're going to look at tabs 1, 2, and 3. We're going to look at required startup funds. Let me share my screen right quick. So we're going to look at shared startup funds, required startup funds. We're going to look at salary and wages, and we're going to look at fixed operating expenses in this video. Then I'll make a subsequent video that will talk about the next few tabs. So the first thing we're going to do is on the introduction tab, we're going to enter the name of our company. And for our examples now, I'm just going to be making up information off the top of my head, just so that you can see how the data rolls together and creates a financial statement. So we'll see if the data I make up is profitable or not. But just know I'm not thinking of anything in particular. I'm just kind of making up the numbers as I go here. So I'm going to enter the name of our company, and I'm going to call it ABC Widget Company, and we're going to sell widgets. Is that how you spell widget? Let's fix it. There we go. Widget. ABC Widget Company. And now I'm going to move on. That's all you have to do on the introduction page is just put your company name. Then I'm going to move down here and click on the first tab. And in this section, we're going to talk about how much cash we need or how much money we need in order to start up our business. So this is a business that has not started before. It's brand new. And we're going to talk about what might go into these spaces. So if you look here, real estate land, remember we're only typing in yellow or green spaces. So I'm going to talk about each one of these so that you'll know what goes in the blank if it applies to you. So the first section we're going to look at here is what we call startup funds fixed assets. An asset, if you remember from your accounting classes, is something that you own. It is something of value that belongs to you. So whenever you purchase a fixed asset, the purchase price determines its value at the time you purchase it. So here you see real estate or land. So if you were purchasing a piece of property to build on or a piece of property to house your business, then you would put the price that you pay for the land in the yellow box here. If you're not purchasing a building, real estate, then you would leave this blank. The second one is building. So here again, if you're purchasing a building, that means you are going to own the building because we're talking about assets. So if you lease a space, that is not ownership, right? You're borrowing someone else's asset when you lease. So the only time you would have a number in the building section is if you actually purchase a building. And so let's say that you buy a building for $500,000 and you get a mortgage on that building for $500,000. Then you would put the $500,000 right here. For our example, we're going to lease a space because we are just starting out and we don't have a lot of cash. So we're going to lease a space to house our business. And when I lease the space, usually whenever you lease, particularly a retail space or a warehouse space, it's just white walls. I mean, you don't get anything fancy in there. So if you want offices or production area or sales area or things like that, you have to finish out the inside. So in the whatever you pay to finish out the inside, that basically is your value. So anything that you do to improve that leased space is what we call leasehold improvements. And the amount of that would go here on leasehold improvements in the yellow box. So for our example, I'm assuming that we have to spend $20,000 to build out our production area and our office area inside the space that we have leased. The next one says equipment. So if you have to purchase any equipment, well, we are going to need some equipment to build our widgets. And we're also going to need some office equipment like copiers and things like that. So for just nice round numbers, I'm going to put $100,000 worth of equipment here. And then, of course, in the offices and our nice waiting room, we're going to need some furniture and some lamps and tables and stuff like that. So we're going to buy some used ones and we're going to put $2,500 there. So that's furniture and fixtures. And then if you're going to have any automobiles, well, I think we're going to need a delivery van for sure. So we could lease that delivery van or we could purchase it. I think I'm going to purchase it. So my delivery van might be, let's say, $70,000. Now I'm going to have to get a loan to get that vehicle, right? But that's still the same as buying it. So I'm going to put that here as an asset. And then any other fixed assets that we might have, and I don't know what that would be right off the top of my head, but I'm going to go ahead and put $3,000 there. So if you'll notice here, it's adding up all of these numbers and it's putting my total here at $195,500. So right off the bat, I know that just to fix out my space, buy my equipment, get some furniture, buy the delivery vehicle, and then a few extra other assets, I'm going to need to come up with $195,500. Now, you asked me what's over here in this green box, and it's green because they've already put data in there for you. But green means that if you don't agree with that data, or if your situation is different, this is where you would change it. So if it's green, you can change the data. So this is depreciation. And just to give you a quick explanation of depreciation, the best example I can give you is that when you buy a brand new car, and you buy the brand new car, and let's say you spend $30,000 on this brand new car. And so it's going to show up on your balance sheet as your assets as $30,000 because that's what you paid for it. But at the end of the year, 12 months later, when you've been driving it around, is it still worth $30,000? It is not, right? It's decreased in value because we've used it. We've used up some of the value. So we have to account for that in our accounting and in our bookkeeping because it has decreased in value. Now, so we call that depreciation. It has depreciated in value. So the IRS says, well, you can actually write that off, right? Because that's an expense. We used it up, and we used it up in the course of our business, and so that's an expense. And we can use expenses to offset our income and lower our taxes that we pay on the money that we make. So we have to keep up with our depreciation in our accounting. Now, the IRS has some very strict rules about how you depreciate things. And I'm not going to even begin to go into that here, but just know that we're taking that into consideration with this green box here. So if you notice here, if you buy buildings, buildings depreciate over 20 years. So basically the IRS says that you use up buildings over a 20-year period. So if I buy a building today for $20,000, $20 million, at the end of 20 years, it would be worth nothing per the IRS. Now, you and I both know I could sell that building, right? It does have value, but it will no longer have value on my books. So we get to write that off as an expense, which offsets our income. So you can see here, we've put 7 years on leasehold improvements, 7 years on equipment, 5 years on the rest of these things, furniture, fixtures, and equipment, vehicles, and other fixed assets. So these are just general numbers based on what most people find the IRS requires. But it can be different in your situation. So if this is a for real thing, you want to check with an accountant, a tax accountant, and make sure that you get these numbers right. That's very important. And depreciation can get complicated, so I'm not going to go much further into that, but that's how this works. Now let's look at operating capital. So these are things we need to buy to get started, assets we're going to need. Then we also need to have some cash to just get started, right? So we may have some people that we need to hire before we actually sell anything, before we actually open. So for example, if you were going to hire someone to do your marketing, or if you were going to hire someone to maybe build out your space, build out the space as long as they're an employee, or begin working on widget designs or something like that. If you have to pay anybody before you actually open your business, are you going to make some products before you open? Those types of things. Then that salary would go in here. So I'm going to assume that we're going to need a product designer, and we're going to need someone to do some marketing and advertising for us. So these are people that I'm actually going to hire that will stay on the team. And we're probably going to have to pay them for a couple of months before we can actually get started. So let's just say that they're each going to make $4,000 a month. So we'll put $8,000 in here. Then insurance. If I'm leasing a space, I'm going to have insurance on that space. I have to have renter's insurance. I might also need liability insurance. I'm going to definitely need insurance for the vehicle, the delivery vehicle. So the way insurance typically works for businesses is that you pay like 6 months at a time. So I'm going to pay that 6 months worth of insurance premium, but then I'm going to use it up over 6 months. So I'm going to we'll just assume for nice round numbers, it's going to cost us $1,000 a month, and I need to pay $6,000 up front. So once I pay the $6,000, they're going to say that I'm covered for 6 months. Inventory, if I have to buy anything that I need to keep in inventory. Well, so I don't know what these widgets are that we're making, but let's assume that we need to buy some raw materials in order to make those widgets. And so I'm going to buy $20,000 worth of raw materials to make our widgets, because we're going to need that before we open so that we can make some products to sell. Legal and accounting fees. I'm probably going to need someone to draw up some agreements with suppliers or vendors or things like that. And I probably will need an accountant to set up the books unless I'm going to use QuickBooks. So we'll assume we're using QuickBooks. And we probably will want to have some sort of a lawyer take care of our copyrights or our trademarks or those types of things. So I'm just going to put 2,000 in here for a lawyer. We won't need much. Then since we're leasing a space, if any of you guys have ever leased anything, you know that you typically have to pay first and last month's rent up front, right? And a security deposit. So let's assume that our rent is $2,000 a month, and that they're going to charge us first and last month's rent. So that's $4,000. And then an additional month's rent for a security deposit. So we'll put $6,000 here. They're not going to turn my utilities on without a deposit. So let's put 500 here. And then will I need some supplies? Yes, probably. Let's put another 500 there. Again, I'm just making up these numbers. And then before I open, am I going to do any advanced advertising and promoting? So we definitely will, because we want people to be ready to buy from us once they find out, once we open. So I'm going to put $2,000 there. Do I need any licenses? I don't know. I'm going to put $100 there. And then any other initial startup costs, so anything else we can think of could go here. I'm going to leave that blank for now. And then working capital. So working capital is cash in the bank. This says cash on hand. That means in the bank. I can't start with nothing in the bank, right? I'm going to have to pay people, and I'm probably going to have to pay my light bill and those types of things before my cash really starts rolling in from sales. So I need to have some cash in the bank. Now we're going to put a number in here. And once we get through and it calculates over to our cash flow statement, we're going to find out if it was enough. Did we start out with enough cash for it to carry us through until our revenue could be pick up and keep us going? So I'm going to put $100,000 in here. Is that enough zeros? Yeah. Because we're going to have enough cash to operate until our sales get strong and steady. So this now we look at, we need $195,000 to buy our assets, our equipment, our building improvements, furniture, fixtures, stuff like that. We're also going to need $145,000 just for all this stuff we're going to have to pay for before we can ever get open. So now that gives me a total of $340,600 that I need in order to open the business. So this is an important number, and it's really important that you do good research here, that you don't fudge it low. Better to guess high than low. And then this number right here is one that after you run your financials, this is one that we normally have to come back and tweak a little bit because we're just guessing. All right. Now, if you already have a business, then what you would do here is you would take how much cash you want in the bank, and you can also consider bills you need to pay and people that owe you money. So like if you sell to people and they pay you 30 days later, you can consider that as cash on hand. So that's what this red line means right here. I'm assuming most of us in the class are startups, so there is not an existing business. All right. Now, so we know we need $340,600, And the question is, where is it coming from? So now we have choices of where we could get this money, right? We can get it from ourselves. That would be owner equity. That's basically the owner's going to put his own money into the company. That's like you're investing in your company. So that whatever amount you invest is your equity. It's your ownership in the company. We could also ask outside investors to put money in the company. We could go get a loan. And we could get a mortgage, we could use our credit cards, we could get a vehicle loan, we could use other bank debt. So right now, it put this number in, it said, okay, you're going to go get a commercial loan for all $340,000. But if you've been reading your chapter, you know that it's very difficult for a startup business to get a new loan, get a loan at all. They want to see, investors want to see that your business is growing. Bankers will want you to put up a lot of your own money first. And so that's really not very reasonable. So I'm going to clear this out right quick. And now what I'm going to do is I'm going to say, okay, where are we going to get this $340,000? Well, I'm going to say, well, let's say I have $100,000 that I've been saving to start my business. So I'm going to put that there. And I have my family, there's people in my family and my friends, and they've said that they can give me $50,000. So I'm going to have a loan from my, or no, not a loan. My family and friends are going to say they'll become an owner in the business. So they'll own $50,000 worth of equity there. And then I have some credit cards that I can use. So I'm going to put 75,000 on credit cards. And this car that I bought, the delivery van, that was $70,000. Well, I'm going to just have to put a vehicle loan here. I'll put 10,000 down on that. So we'll get a loan for 60,000 here. So now between my family and friends, my credit cards, and the vehicle loan, I've managed to raise $285,000. So I still need, what would that be? Oh, 285. So that's 15 and 40. So I still need $55,000. So the bank, maybe we'll say, well, the bank will give me 20,000. Commercial loan. Maybe the bank will give us 20,000 in a commercial loan. That's not very much considering we need 340, but they probably won't give you very much, at least till the company gets going. So we have $20,000 commercial loan. So now we need $35,000 more dollars. So we're either going to have to put more on the credit cards, put more in from our savings, or get our investors to give us more. So we're going to go find a few more people who are willing to give us a little bit more, and we'll put 85,000 here. All right. I need 600 more dollars. I'll throw that in the pot here from my savings. So now we're at 340,600. So the total required is 340,600. Total sourced is 340,600. So we know we were able to raise that enough money to cover all these things we said we're going to have to pay before we ever get open. Now, just like we had the IRS depreciation factor here, we also are going to put in our loan rates and the terms here. So for example, this commercial loan, we got a $20,000 commercial loan. Well, I can put whatever the interest rate for that loan is here. So we're just going to leave these assumptions as they are. But if your loan was really at 11%, well, you would need to change this to 11%. And then the term in months. Well, so this is 84 months. That's a long time. That's what is that, 7 years? So they aren't going to give us $20,000 over 7 years. They might give us 2 years to pay that off. So I'm going to change that to 24 months. So we have 24 months to pay it off, which means if it's at 7% for 24 months, our monthly payment's going to be $895.45. We have a credit card debt that is always high at 22%. No, 7%. I'm sorry. They have it at 7% here. We know that's not right. Credit card debt is going to be at least 15%, maybe 20 something. So that's going to be $1,700 a month payment. And then our vehicle loan is $60,000 at 6% for 4 years. This is for 5 years. And our car payment would be $1,409.10. So now we can see that this amount of money is going to cost us $4,088.80 every month. So this is the picture of what we need to start up, how we're going to get that money, and what it's going to cost us every month to obtain the money. And so now you know why I put a big number here, because right off the bat, we're going to be paying $5,000 a month just to the folks that gave us the money before we ever have to pay for any operating expenses. All right, I'm moving on to tab 2. This is salaries and wages, and this is where we're going to talk about the people that we are going to pay. Now, again, we're not going to worry about years 2 and 3. However, it's going to self-calculate. It's going to assume a 3% escalation for years 2 and 3. We're going to complete only year 1. So the first thing we're going to do, remember, we're filling in only yellow and green boxes. So you're going to put here how many owners there are. And we know from here that we have a few owners, right? Because we have this owner, us, and we have these other investors, which we can pay a salary to if they're going to work there, or we can just pay them dividends from the profits. So for our situation, we're going to assume that these people invested in the company, but they're not going to work there. So I'm not going to consider them as employees, and they're not going to get a salary or an hourly wage. The only person I'm going to pay as an owner is myself. And so I'm going to come back over here to this salaries and wages tab 2. And I'm going to say that we have one owner, me. And then it says, how much are you going to pay yourself every month? Well, if I want to make $60,000 a year, I'm going to be conservative because it's a new business. I would have to pay myself $5,000 a month. All right. So now that's going to be $60,000 for a year. Now, how many other employees do I have? And these are people that are salaried. How many salaried employees do I have? Well, if you remember, I put 2 salaried employees in, a marketing person and a designer. And so I put them in at $4,000 a month. I have 2 of them at $4,000 a month. So that's going to give us, let's see, 4,000 times 12 is 48. Oh, so I need to make this 8,000. All right. And then it says, okay, now the people that you're going to pay hourly, you're going to have full-time employees and part-time employees. So you'll say how many of them you have. This is the number. And then this is the average number of hours that they work a week and the estimated per hour. Now I know that like you'll have multiple people that are in different jobs and they might get different pay rates. So for purposes of this template, you would just have to say on average, I'm going to pay my hourly people this amount of money. If you had a real business, then you were doing this in QuickBooks, you would obviously put in every pay amount and all of that would calculate correctly. So we're going to assume that to start off, we're going to have no more full-time employees. We have the 2, well, I don't know, we're going to make widgets. We might need some employees. Let's say 3 full-time employees that'll work 40 hours a week, and $9 an hour is a terrible salary. Let's make it 15. So $15 an hour, that's still not great, but it's better than 9. And then we're also going to have maybe 5 part-time employees that'll work 20 hours a week, and they will make $12 an hour. And so these folks will be like back in our production area, or maybe they'll be like telemarketers or something like that. So now we see that we have 11 people on the payroll, myself, the 2 people we talked about, marketing and design, and then our workers. We have 3 full-time and 5 part-time. So that gives us 11 workers. And on average, we're going to be spending $26,000 a month for payroll. So just to pay our people, we're going to need $26,000 a month. Now, over here, this is going to automatically calculate the payroll taxes that we have to pay. So these are the standard amounts. I don't know if these are still current or not, but we're going to assume they are, and we're going to leave them as at that. If you would put your specific amounts in these green boxes if you needed to. Now, this one has a pension program built in. Obviously, we don't have a pension program yet. So now I know that I'm going to spend $26,000 a month on payroll. I'm also going to be spending $3,254 a month on payroll taxes. So my total monthly cost for salaries and taxes is going to be $29,254. So now we know so far what we're going to be paying every month. From tab 1, we're going to be paying $4,088.80 for our cost of funds. And we're also going to be paying $29,254 a month for salaries. So right now we're at almost $35,000 a month for people and money. Now we're going to move on to our operating expenses, which is tab 3. So our fixed operating expenses, let's talk about the difference between fixed expenses and variable expenses. So a fixed expense is something that stays the same or relatively the same, regardless of how much you produce or how much you sell. So in my bakery business, I had fixed expenses and variable expenses. And so if you think about variable expenses, they are the expenses that change with the amount of production that you create. So if I was making 2 wedding cakes a week, I would need a certain amount of flour, sugar, butter, what else? Cream, those types of things, salt, baking soda, all of that. I would need a certain amount. But if I made 20 wedding cakes a week, I would need more sugar, butter, flour, salt, cream, that type of thing, right? So that's a variable expense because it varies based on how much I produce. On the other hand, at the bakery, I had to pay rent on my space. My landlord didn't care if I made 2 cakes or 20 cakes. I had to pay the same amount of rent. So that rent stayed the same every month. My utility bills stayed relatively the same every month. What else would stay the same? I guess like any kind of like repair agreement that I had for my equipment, that I paid that the same every month. Those were fixed expenses. So on this sheet, we're looking at those fixed expenses. What are the expenses that we're going to incur every month, day in, day out, regardless of whether we're producing, 10 widgets or 100 widgets? So let's look at the list. These are the list of the most common. If you have something different, you can put it, you can put it on miscellaneous or whatever. So advertising expenses. Typically, you're going to be having an advertising budget, and you're going to spend, say, you're going to spend $1,000 a month. So I'm going to put that in here, $1,000 a month for advertising. And then car and truck expenses. I have that delivery van, right? I'm going to have to pay for gas. I'm going to have to pay for oil changes, that type of thing, depending on how many miles I go. Now, you may say, well, some months you're going to have more than others, and that's right, but it's not tied to production. So you can have a change every month, but unless it is specifically the result of production levels, then it's a fixed cost. So what we normally think of is we think of when we budget, we think, well, we know we're going to have maybe it's a seasonal business and we deliver a lot more in, 9 months out of the year and we have 3 slow months. So as we're predicting what we're going to spend every month, we take that into consideration and then average out that monthly amount. So I'm going to just say car and truck expenses, including gasoline. I have no idea. Let's say 500 a month. Bank and merchant fees. So if you have a bank account, a commercial bank account, sometimes they charge you a monthly fee to have that account. So I'll put $25 there. Contract labor. This is when you hire people that they are not your employee. And there are a lot of really strict rules around contract labor. A lot of people do that wrong and get away with it. But when you get caught, it's not pretty. So if you're thinking about using contract labor, I would love to have a conversation with you about that. For most people, it's not the greatest idea for the contract laborer or the business in case they get caught. But we'll talk about that. A lot of people think if they hire contract labor, they don't have to pay payroll taxes, and that is true. However, the IRS has some very strict guidelines on what constitutes contract labor. So if you hire someone as contract labor, but then you manage their work, they are not contract labor, and the IRS will go back and penalize you, and they'll also make you pay the back payroll taxes with interest. So this is something you want to be really careful about. So we're not going to use those in our company. Conferences and seminars, if I go to those, and maybe I will, maybe I'll go to a couple of those. Let's put $2,000 in there. Oh no, for the month, I was gonna say for the year. So let's put $200 a month, which would give us $2,400 for the year. Customer discounts and refunds. If you're going to offer a certain amount of discounts every month, I don't know, I probably leave that blank for now. Dues and subscriptions, I may subscribe to an industry magazine, and let's say that that's going to cost us $360 a year. So I'll put $30 a month here. Insurance. Now, remember, we had to pay that 6 months worth of insurance up front. So we've already paid, what did I put? We already paid insurance, prepaid insurance. We paid $6,000, so I had it $1,000 a month. So we already paid $6,000. So that's already been paid at the very beginning in our startup costs. So for the remainder of year one, I'm going to have another $6,000, which comes out to $500 a month, because I want this total to be $6,000 here. And the other $6,000 is going to fall into those startup expenses. Licenses, permits, and fees, we already paid for that before the year started. We put that on our startup funds. Legal and professional fees, we put that on our startup funds at $2,000. So we'll pretend that's going to hold us for the year. Office expenses and supplies, we might need $50 worth a month. Postage and delivery, let's do another $50. Rent on business property. So we've leased a space. That's going to be a big ticket item, probably $5,000 a month. Rent of vehicles and equipment. We purchased our equipment. Sales and marketing expenses. We have $1,000 for advertising. Let's just put another $1,000 here. And then any other taxes you need to pay, and then your telephone and your internet and all of that. I'm making up numbers. If you're going to do any travel and any utilities. So now you can see that I have figured out $9,555 a month in fixed expenses, operating expenses. Now down here, it has already calculated our depreciation and our interest. And it's assuming that we have a line of credit with the bank, and our credit card debt and our vehicle loans. So it's making some assumptions based off of things that we have already calculated. So we're going to be paying, we're going to be expensing this is not a cash expense. This is that depreciation is that reduction in value of your assets that you get to treat it like an expense, but it doesn't take cash. So this $95.55, that's cash. That's stuff we're going to have to pay. The commercial loan, we're going to have to pay the interest. Line of credit, we're going to have to pay the interest. Credit card debt, vehicle loans, all of that, we're going to have to pay the interest. So these are all things that will also cost us money. So our total fixed operating expenses are $14,498 a month. $2,600 of that will not be cash. So we would have whatever that would be, almost $12,000, a little bit less than $12,000 worth of cash we need to come up with every month for these operating expenses. All right, so I'm going to stop here with this video because that was a lot to take in. You can begin thinking about your numbers, and I'm going to make another video now for the projected sales forecast, and we'll talk about projected sales, which is tab 4, and we will talk about cash receipts and disbursements, which is tab 6.